Welcome to the Basic Accounting Principles PowerPoint. We're going to start off by looking at what is accounting. Um, in a sense, it's anytime you are buying, selling, transferring, exchanging, you are creating a financial transaction. And accounting is a way of merely reporting those financial transactions. Some of the accounting terms we're going to be using this semester come from two of the most important financial statements. The first one is the balance sheet. What we look at on the balance sheet are assets, and that's what the company owns, liabilities, which is what the company owes, in other words, what they have to pay out, and then the last is equity, and this is what portion of the business the owner actually owns. When you think of equity, what you want to think about is if you were to go out and buy a house, let's say you were going to buy a $100,000 house, you don't have $100,000. What you do have is $10,000 so that you can put down a down payment. Now, you're going to tell people you own your house. However, the reality is that the bank owns 90% of your house. The way this works out for you is that every month, the more you pay your mortgage, the more of the house that belongs to you. So your equity in the house increases. That's kind of the same thing, but on a much larger scale when you're talking about equity. It is the actual amount of the product, asset, that you actually own. Now, the other two accounts that we're going to be looking at, the first one is income, and this is from the income statement. Income is the money the company makes, what it earns, and expenses is the money the company spends. Another important element is something called the chart of accounts. Every company has a chart of accounts that lists all of the accounts used by a business, and here's an example of one. And these are the accounts that a company uses on a regular basis or even on a once in a year basis. And it allows for them to track their spending. This is one of the most important elements in accounting is the ability to track your spending, your income, to be able to predict, to be able to identify trends, those kinds of things. And this is why we need to learn these things so that as you move forward in your life, not only in your professional life, your business, but you also need to know this for your personal life. We're going to look more closely now at something called asset accounts. These are the resources of the company. There are three characteristics of an asset. First is a future probable economic benefit. Now, let's say, for example, that you are opening your own restaurant. And one of the things that you need is a stove. So you go out, you buy your stove, you bring it home, you bring it back to your restaurant. And what it's going to do is allow you to cook food so that you can have customers who will pay for their food. That is a future economic benefit. Second characteristic is that it's controlled by the company. And the third is results from a prior event or transaction. So going back to the example, you went to the store, you bought the stove. Either you paid with your credit card or you paid cash. That is the transaction. Now the examples that I have here are cash, always a good economic asset, vehicles, account receivables, which are IOUs. So for example, let's say you're running a computer repair business and one of your customers can't pay you this week because they don't get paid till next week. And you know the person and you decide, yeah, it's fine. You can just pay me next week. Well, that is an IOU. They owe you that money. But in accounting, we call that an account receivable because that sounds way better than IOU. Next, we're going to look at liability accounts. Liabilities are a company's financial obligations it has incurred conducting business operations. The characteristics of a liability represents a transfer of assets or services at a specified date, and the event causing the obligation has already occurred. So, for example, let's say that your restaurant is going well, but you get a lot of people who want you to deliver. So, you need a car. So, you buy a car, except you don't have the cash that's needed. So, what you do is you get a car note, a loan. Well, that loan becomes a liability. You have to pay off that car note at some point in the next 3 to 5 years in order to have this vehicle. Lastly, we're going to look at equity accounts. And this is the portion of a company belonging to the owners represented by capital investments. Capital investment is something where you put your own money into the business. So, for example, let's go back to starting the restaurant. You have $50,000 that you're going to put in of your own money. That is a capital investment. The other portion of equity is accumulated earnings, less any financial obligations, expenses, notes, those kind of things. So, for example, let's say in your first year running the restaurant, you make $100,000 in profit. That's less all your expenses, you've paid all your bills, and at the end of the year, you have a nice tidy sum of $100,000. Well, the $50,000 that you put into the business plus the $100,000 that you made that year is now your net worth. In accounting, there's something called a double entry system. And again, I've promised you I'm not turning you into accountants, but these are those kinds of very basic things that you need to know when you are out in the business world, or even if you're doing your own accounting for a small business. You have 2 account entries for every transaction. So the example that I give is if you pay your company's electric bill, you would take the money out of the cash account and add the amount to the electric expense account. Now, on a much smaller level, imagine going to Wawa to get your coffee. What happens? You give them the dollar, they give you the coffee. So it is a quid pro quo, which means something for something. And of course, if you quote Latin, people think you're smart. So quid pro quo, use that at least once this week. The other thing that you want to remember with this kind of a situation is it doesn't always involve cash. So, for example, let's say that Valentine's Day is coming up and you want to buy your love muffin a bracelet or a necklace. Well, you don't have the cash. So you go to the store and you use your credit card. That is also a 2-step transaction. You give them your credit card, they give you the necklace. Now, down the road, you are going to have to pay your credit card off. And then again, you have 2 transactions. You're sending the company cash, they're sending you a receipt that says you no longer owe what you owed on the credit card. So when you think of accounting, you always want to think of what 2 accounts are being impacted. So now we get to the basic accounting equation, and this is one of those things that you should memorize, tattoo on your arm. It should be something that you could say in your sleep. It is assets equals liabilities plus owner's equity. A equals L plus OE. This is always maintained in a double entry accounting system, and it's going to be fundamental to understanding the balance sheet. Now, the next thing we have to talk about is the difference between a cash-based records versus accrual-based records. Now, I know all these words are thrown at you, and it can be confusing. However, it's very, very basic understanding. Cash-based records involve transactions that are recorded when cash is received or paid out. So, for example, I am buying Girl Scout cookies from my nephew's girlfriend. She got the cookies for me 4 days ago, but I haven't been able to see her yet. Now, today, when she shows up at my house with the cookies, I am going to give her cash and she's going to give me cookies. That's it. That's cash-based records. This is usually only used in very small companies and sole proprietorships. A sole proprietorship is when it's one guy or one woman who owns a small company and it's pretty much them and them alone. Now, accrual-based records is a little more complicated. These are transactions that are recorded when they take place regardless of whether cash is involved, for example, credit card purchases. So let's go back to my example of the Girl Scout cookies. So my nephew's girlfriend, 4 days ago, I tell her through a text, I want to buy 2 boxes of Girl Scout cookies. If we were using accrual-based records, she would mark that down in her ledger as happening 4 days ago. The fact the cash is not going to change hands till today is irrelevant. It's when the actual transaction takes place involving. So when I order something, that's when the accrual-based record kicks in. This is used by most large companies and corporations. So the bigger the company, the more likely they are to use these accrual-based records. Another element that is important to understand, and we talked a little bit about this the first week of class, is something called depreciation. Depreciation are portions of the expense that reflect the using up of an asset employed by the business. In other words, you buy a car, it comes off the lot with 3 miles on the odometer, and after 5 years, you've now worked it up to 100,000 miles. That is standard for vehicles, for cars, a 5-year useful life. When you look at something like furniture, office furniture, the useful life is 7 years. If you're looking for an exterior building, oftentimes they run anywhere from 15 to 20 years. So useful life in accounting is very standardized and has set up specific useful life. So for example, computers used to be 3 years and now they're coming down to 2 or 1 year depending on the industry. So the way that depreciation works is it allows you to spread out the expense over the life of usefulness. So a car that costs you $20,000, when you expense it using depreciation, will only cost a certain amount for each of the 5 years. Now, many assets have what we call a salvage value. So let's go back to our car example. We buy the car, we use it for 5 years. At the end of 5 years, do we send the car to the junkyard? If it's in good shape, no. And then what we do is we can either sell it, we can put it on one of the car buying websites, we can sell it to an employee, but that useful life has to have the salvage life deducted from it. So when we think of that $20,000 car, if we know the salvage value, or for example, the Blue Book value is $5,000 after 5 years, then the useful life minus the salvage value equals how much we can depreciate over those 5 years. So, just to kind of review, we have a $20,000 car with a $5,000 salvage life. So $20,000 minus 5 gives us $15,000. We're going to depreciate that $15,000 over 5 years. So 15,000 divided by 5 equals 3,000. So our depreciation expense is $3,000 each year, rather than having that 20,000 hit immediately. One of the downfalls to depreciation is that it can overstate or understate true income. But we'll talk about that in way more detail later on in the semester. There are two types of depreciation. Accelerated method is used by accountants for big companies, and what that happens is that when you take your depreciable amount, and let's go back to my car example, 20,000 minus the 5,000 salvage value equals the 15,000. Well, a company may do something called an accelerated method, meaning they take $10,000 depreciation expense that first year, and then they take $1,250 for the remaining years. The purpose of this is, say for example, we know we're having a terrific year this year. We're making money hand over fist. You've got tons of money sitting there. Well, your accountant might say, we need to increase your expenses so that you don't have to pay so much tax. So in that case, you would use the accelerated method to bring down your earned income so that when it's time to tax that income, it's smaller than what it actually is if you use the straight line method. So we're going to be looking at some common financial reports. The first one is the balance sheet, second, income statement. Then we move into the statement of cash flows and the statement of owner equity. First, let's look at the balance sheet. Very, very, very important. You have to remember that it represents a financial situation at a single point in time. So a lot of balance sheets will end at the end of a month, at the end of a fiscal period, end of the year. And that represents the assets, liabilities, and owner's equity on that day. Go 1 week in the future, it could totally be different. But on that particular day, that's where the company's assets, liabilities, and owner's equity lies. And as I mentioned before, assets are what a company owns, liabilities are what it owes, and owner's equity is what the owner actually owns of that company. And the balance sheet summarizes this information. Now, there's two different kinds of assets. The first kind is called current assets, and those are assets that will be used up within a year. So we call cash a current asset because it's easily converted into a transaction. And then you have things like office supplies. So the office manager goes out and she buys all the paper and the pens and tape and staplers. And over the course of that year, as they get used up, that asset account is going to become smaller because there's going to be less and less of that asset. That's why companies do inventory, because they need to be able to value what they currently have on hand, because that is technically an asset for them. Now, the other kind of asset is a non-current asset. And these are assets that will be utilized over the course of their quote-unquote useful life. The oven that we bought for our restaurant, the car that we bought to do deliveries, if we were running a computer business and we had purchased servers, again, what we would be looking at are non-current assets. In the same vein, we have current liabilities and non-current liabilities. So a current liability are debts that are going to come due within 1 year from the balance sheet date. So for example, remember we bought that car and we got a note we have to pay. Well, if that note is going to come due within the next 12 months, that note payable, that IOU we are paying to the car company, gets moved into current liabilities. The other kind is a non-current liability, and these are debts that are due more than 1 year from the balance sheet date. So, for example, a mortgage. Most mortgages run between 20 and 30 years. They are definitely not current unless you're about to pay off your mortgage. So the mortgage payable generally sits under the non current liabilities.